Well, speaking about inflation, inflation, economists may argue that this is a sign of continued expansion, but could we also see stagflation, where there is inflation but where growth stagnates?
Well, we could, and of course that's exactly what we saw in the 1970s. Sort of blew up the Phillips curve. I never thought the Phillips curve worked. A lot of people did. Janet Yellen stayed with it all through her tenure as chair of the Fed. But even the other day, Jay Powell in his press conference said, "Well, it looks like the Phillips curve doesn't work." Well, that's another way of saying it never did work. But the idea was that when unemployment is low, inflation gets hotter. Or if unemployment is high, inflation gets lower. Well, the fact is that relationship doesn't hold. We've seen every combination. We've seen high inflation, high unemployment. Mm-hmm. That's stagflation. We've seen low inflation, low unemployment, which is what we have today, and every other condition. So the question is, could you get stagflation today? Well, half of it is low growth. We have that part. The growth is very low. It's not negative. We're not in a recession. But we're close to it, and the rest of the world is worse off. Where's the inflation going to come from? And here's the key. Going back to Milton Friedman, he got a couple things right, but most of what he propounded was wrong. But he said, inflation is always and everywhere a monetary phenomenon. That's an exact quote. Print too much money, you get inflation. That's not true. Money doesn't cause inflation. What causes inflation is velocity. It's the turnover of money. Now, okay, high money supply is the raw material, but you still need that turnover, and we don't have that. That's nothing to do with the Fed, nothing to do with the printing press. It's psychological. Depends how people feel. If they're feeling prosperous or they're worried about inflation, they'll go out and spend it. But if they're conservative, trying to reduce their balance sheet and not worried about inflation, they'll save it or invest it, and that's what's going on. So the only way it can change velocity, it's a psychological effect. You can't do it with the central bank. You have to find another way to do it. By the way, gold is a very good way to do it, but that's not something the central banks are thinking about.
Jim, I want to talk about recession since you brought that up. You said we're not there, but we're close to it. So let's drill that down deeper, because I've been attending a lot of bank outlooks now, and they're saying, yeah, we were worried about a recession earlier this year, but now those worries are gone. It's kind of like we don't have to think about it for 2020. How do you see it?
That's probably right. The near-term forecast, let's say 3 to 6 months, those forecasts, depending on your models, can be extremely accurate. I look at a number of different forecasts. I don't really rely on sell-side research. I don't trust Wall Street very much, but there are independent analysts and economists who are doing the same work, and they give recession almost a zero chance in the next 6 months, and I agree with that. And probably not more than even a 30% chance in the next year, and I agree with that also. But the reason is, just to be fair, here's one of the things that Milton Friedman got right. He said monetary policy operates with a lag. So the slowdown that we're seeing right now, I mean, you look at the 4 quarters of 2019, growth dropped from over 3% to now about 2%. Looks like fourth quarter might be around 2%. So growth slowed down in 2019. That was the delayed effect of the tightening in 2017 and 2018. Remember, the Fed raised rates 4 times in 2018. They also started this crazy quantitative tightening where they were reducing the money supply, which was the equivalent of more rate hikes in terms of the impact. So there was a lot of tightening in 2017, 2018. That slowed up in 2019 to slower growth. But now we're in an easing phase. They got rid of quantitative tightening. They've gone back to quantitative easing as of September. They don't call it that, but I do. We call it QE4. And they cut rates 3 times this year. So again, going with the idea that it works with a lag, that easing, 3 rate cuts and more and QE4 will begin to show up in 2020, maybe the middle, late of 2020, just in time for the election, by the way. So I think we're far from a recession. Although this time last year we weren't. I mean, that tightening was really starting to bind, and Jay Powell got religion right on day after Christmas. Yeah.
So we can sit back and perhaps relax in 2020 and not worry about it. But because if we look at 2006, when the bond curve inverted, the yield curve inverted, then it re-inverted, but then we saw what happened in 2008. So could we potentially see a similar pattern where we've just stalled the bad news coming?
Well, we could, but interestingly, the Fed actually seems to be, they're usually behind the curve, and they still are in some ways. But this they seem to understand. Now, the yield curve inverted last August. And again, when you say yield curve, you got to pick your spots. You know, you're looking at 2s to 10s, or some analysts look at 3-month bills to 10-year notes. I think that's a good way to think about it. But it did invert last August, and of course, all the Democratic presidential candidates were running around saying, the yield curve inverted. I don't think they know what a yield curve is, but they knew the words, the magic words, and so they said the yield curve inverted. Here comes a recession, as if that was going to defeat Donald Trump. Two things they didn't realize. Number one, yeah, yield curves invert before recessions, but the average is 22 months. That might have been telling you were going to have a recession at the end of 2021, a little bit after the election. But then the Fed actually got the message through a lot of people beating on them, different analysts and so forth, and they straightened out the yield curve. Now there are two ways when the yield curve is inverted. So here short-term rates higher than long-term rates. You want to get that relationship going the other way. Well, there are two ways to do it. One is you can lower short-term rates. Well, that'll do it. Or the other one is, raise long-term rates. What they did is they chose to lower short-term rates. That's what this QE4 is all about. They're buying hundreds of billions of dollars of Treasury bills. They're not buying 10-year notes.
But don't call it QE4, right?
Yeah, please don't call it QE4. Although, remember when they started in September, they said, well, we're going to do this for a week, 75 billion a day. And then they said, well, we're actually going to do it for 2 weeks. And they said, well, we're going to do it indefinitely. And by the way, it's 100 billion a day. And by the way, we're extending the repos to 1 week or 2 weeks. So it keeps getting bigger and bigger. I don't think they're going to get this back in the box, but it's really QE4. But it works.
Jim, you're based in New Hampshire right now. Offline, we were talking about how you're running into presidential candidates quite often now, and I'm sure a lot of our viewers can't wait to get your thoughts on the presidential election in 2020. President Trump has some extra competition with a few more billionaires joining the running. Do you think his chances are lower now than in 2016 or higher? How do you see it?
I think they're much higher. And you remember, Danielle, I was in late October, early November 2016. I was on a world book tour for my last book, The Road to Ruin, the one before Aftermath. So I was doing a lot of TV appearances. Great thing about TV is you can save the videos so you can prove what you said. And at the time, the polls, the pundits, the bookies were giving Hillary a 92 to 95% chance of winning. And I said that Trump was going to win. I said it'd be close. We'd be up late, but he was going to win. Most of the anchors, their faces turned white, and they couldn't believe it or whatever. But there were reasons for that. I don't have to repeat all that. But it wasn't a lucky guess. I had a model using Bayesian statistics and other inferential methods, and I have the same model today. You tweak it, you update it. But right now, I'm giving Trump about a 70% chance of being reelected, but there's a little theta in there, just time decay. So I expect that to go up, 2 or 3% a month between now and the election. So I think by election day, he'll be a 90% favorite to win. Mainly, there are a number of factors, but the number one factor is recession. Trump's odds of winning are the inverse of the probability of a recession before next summer. Mm-hmm. So if you say the recession odds are below 30%, that means his odds of winning are over 70%.
Who do you see as the Democratic candidate?
Oh, well, I guess what I'm saying is it doesn't matter. I'm keeping an eye on Hillary Clinton. I think she's very likely to be the nominee. I know she hasn't declared, and she's too late for the.
I remember you tweeted that. You're saying you wouldn't be surprised if she entered.
Yeah, well, the reason is that they may get to what's called a brokered convention. They may get to the convention in July where nobody has more than 50%. You need about 1,000 votes to win. But they have about 700 of these super delegates who cannot vote on the first ballot. So they're not allowed to. But if nobody wins on the first ballot and you go to a second ballot, those 700 superdelegates come out of the woodwork, and they're free agents. They can vote for anybody. So if you have a situation where, I don't know, Biden's got 20% and Warren's got 20%, none of these people look like they're going to drop out. Sanders is still, angry about what happened the last time when they ran him off the road. Biden, I think, is weak, but he won't go away. He's got the name recognition. Warren has her base. Buttigieg's coming on strong. Bloomberg will have a little something to show for his $300 million of TV advertising. So they might just split the vote 4 or 5 ways. Nobody gets majority. But then on the second ballot, as I say, everybody's a free agent. Hillary could come in like a white knight and say, here I am. I beat him last time in the popular vote. We can do it again.
Jim, finally, I'm feeling quite generous. So let's say I'm going to wire you $100,000 cash right now.
I'll give you my wire instructions.
I think our investors would love to know how you would break it up in 2020. I know gold's got to be in there somewhere.
Yeah, I'm a steady Eddie when it comes to gold. 10% allocation. People are surprised I don't say 50% or 100%, and the answer is there are other things that act like gold. And if I'm right about the price target, 10% will be your insurance. So 10,000 would go to gold. This may surprise some of the viewers, but I think stocks are going to have a good year in 2020.
Jim Rickards, thank you so much for joining us as part of our Outlook series. I wish you and your family a very Merry Christmas, and I look forward to seeing you in the new decade.
Yep, Merry Christmas.
Thanks, Jim, and thank you for watching. We'll have much more for you, so be sure to stay tuned to Kitco.com. On behalf of the Kitco media team, we'd like to wish all our viewers a very happy and healthy 2020.
On vous souhaite un très joyeux Noël et passez de bonnes fêtes.
大家好，祝大家节日快乐，新年快乐。
С Новым годом и хороших праздников. Cheers.
नमस्ते दर्शकों, नव वर्ष की हार्दिक शुभकामनाएं। अगले साल मिलेंगे।
Всех с наступающими праздниками. Желаю счастья, любви, здоровья всем в новом году.
A todos os nossos clientes e amigos, Feliz Natal e ano novo cheio de saúde e amor. Obrigado.
Maligayang Pasko sa inyong lahat at manigong na bagong taon.
祝大家节日快乐，新年好。
Ho ho ho! Merry Christmas, Happy Holidays, and I wish you all the best in 2020.
Auguri a tutti i nostri cari spettatori, augurandovi un buon Natale e un felice anno nuovo.